Hello friends, a very warm welcome to my channel. In this video, we are going to discuss about the business of Vishal Mega Mart. It's one of the leading companies in the retail space in India. It's a recently listed IPO which has done very well. It's a cash-rich company growing by its own internal accruals and a very interesting business to study. Before we begin, if you're new to the channel, please do subscribe and hit the bell icon to get updates of all the new videos that I upload. Here is a small disclaimer as per SEBI guidelines. You can pause the video and read it. This will be the flow of our discussion. We'll discuss the business model of Vishal Mega Mart first, then we'll see how the stock has performed on the charts since listing, see the financial performance of the company in the last 5 years. We'll understand why the stock has been consolidating since listing and not making fresh new highs. We'll understand the outlook of the management going forward. We'll talk about the valuations, the risks in business, and then form an overall view on the company. So Vishal Mega Mart is one of the leading retail chains in India. It is based in Gurugram, Haryana. And it is targeting one of the largest consumer segments in India, that is the middle income as well as the lower middle class group. It has a diversified product mix where apparel constitute the major contribution and there are other products as well. They have been consistently growing their stores over a long period of time and they are expecting the same growth to continue in the future also. And in retail business, managing working capital is very important and this company has proven that over a long period of time. Obviously, for scaling such a business, technology plays a very important role and hence this company is using technology to the fullest. They have 72% of their stores located in Tier 2 cities and Tier 3 towns. This shows that their focus is more on these cities rather than the top tier cities in India. And in fact, practically if we see, these cities contribute to nearly 74% of the demand in India in the retail segment. So they are at the right place. So their target market in India is 945 million of our population, which is the middle income and the lower middle income group. In the recent times, the company has started focusing also on the hyper local delivery or the quick commerce model, which has been doing well for this company as well. In their IPO, it was a complete OFS because the company is self-funded and growing with their own internal accruals, so they do not need fresh capital. They have done an OFS of 8,000 crores. This is a broad breakup of their segments. Apparel contributes almost 44% to their revenue, FMCG about 28%, and general merchandise about 28%. There are certain products which are sold by this company of the third-party brands and some products of their own brands. So from third-party brands, the sale is about 26% and the majority of the sale, which is 73%, is from their own brands. What is the advantage if they sell products from their own brands? They can earn higher margins and their own brand value gets established in the country. In terms of geography, if you see, the revenue is well diversified. North India constitutes about 42% of the revenue, East constitutes about 30%, West constitutes about 8%, and South constitutes about 20% of the revenue. In terms of the store count, Tier 3 stores are the highest, which is 324 stores, followed by the Tier 1 and Tier 2, which is 192 and 180. So their more focus is on the Tier 3 cities, wherein maximum revenue is coming from. Altogether, all over India, as on March 31st, 2025, they have 696 stores and they have presence in 458 cities in India, which is a huge distribution network, which is very difficult for a new company to replicate in case they choose to enter this business. In terms of retail space, they have 12.2 million square feet. Company came out with an IPO around 1 year before at a price of about 78. There was a decent listing and the stock made a high of around 125 later and then began to consolidate, and with recent good results, the stock is again heading towards the high of 125. 95 to 100 is acting as a strong base or a strong support zone for the stock. If you see the 5-year track record in terms of financial performance, in FY21 they did about 4,500 crore of revenue, which is nearly doubled to 10,700 crores in FY25, which is a steady, consistent growth. EBITDA has also shown a similar trend, in fact better. From 626 crores in FY21, it has grown to 1530 crores in FY25. They've made consistent margins of EBITDA at somewhere around 14% in spite of several internal and external events happening in India, which shows the resilience of this business model. The same store sales growth in FY25 has been 12.3%, which is quite impressive. And the store count has grown from 611 to 696 recently. They are very efficient in managing their working capital and their working capital days are just 15 days. And if they set up a new store, their payback period is just 19 months. ROC on the face of it, if you look at the financials, appears to be unimpressive, which is just 13%. But if you see the adjusted ROC, it is 67%. Now what is adjusted ROC in this case is, this business leases different premises to set up their stores. As per the Indian accounting standards, these lease assets and liabilities have to be disclosed in the form of assets in the balance sheet and in the form of liabilities on the liability side. So this increases the capital employed in the business, and visually the ROC appears to be less. But if you remove these assets which are leases and not the assets which the company has actually bought, then the adjusted ROC is 67%, which is a right way to monitor such a business. Similarly, if you give the impact of the lease rent on the P&L, the actual EBITDA margin comes down from 14% to 9.6%, and the PAT comes to 6.3%. So the margins have been very consistent, but a PAT margin of 6% is not very impressive. The company has generated very strong cash flows, and the OPCF, which is operating cash flows in FY25, have been 1400 crores. So that's why with such cash flows, the company doesn't need fresh funds to grow. So here is a glimpse of how the adjusted ROC is calculated. You can have a look at it. Now, what is the reason for the stock to continue to consolidate in spite of such consistent growth from the company side? The valuations have been very expensive. That is primarily the reason, and that's why till they become reasonable, the stock may remain in a range-bound manner. The market sentiment has also not been very strong in the last few months. That has also contributed to this movement in the stock price. Before we move forward, if you're not a part of our Telegram channel yet, do join today by clicking the link in the description button. Every day morning before the market opens, I share my view on the market. I also share how I am allocating my capital, interesting news and views. All these things will help you become a better investor. More than 7,000 people are daily in touch with me through my Telegram channel. Now, what are the growth plans of the management going forward? They will continue their aggressive store expansion. They will continue to grow their product basket by adding new products. They will focus or continue to focus on their private labels, which are the higher margin products. They also have a loyalty program, and 95% of the sales from their customers comes from the customers which have already signed up for their loyalty program. 17% of their loyalty program customers have increased year on year. And out of their total stores, 656 stores are doing the hyper local delivery, which is kind of a quick commerce model. Although the overall company is growing, but their own brands are growing faster than that. In FY22, the sales from their own brands was about 3922 crores. And it has grown in 3 years to double 7838 crores. So this is how is their focus on their own brands, which are 26 brands. Now coming to the most interesting part, that is the valuations for this company. I have calculated the valuations in a different way, which is suitable to this business as it has lease liabilities. So the market cap is around 55,700 crores for this company. Cash equivalence is about 397 crores. Debt is nil. There is no external debt. So the EV comes to the enterprise value as per the formula comes to 55,374 crores. Now I'm not taking the usual EBITDA here. I'm taking adjusted EBITDA, which is reduced from the 1500 crores to 1033 crores because of the adjustment due to the lease rent. This will give a more clear picture in this kind of businesses which have lease liabilities. So the EV by EBITDA comes to 53 times, which is expensive. This is the most suitable method of valuation for such companies which have lease liabilities. Now we also can see the usual methods which we do, which is PE is about 88x and EV by EBITDA without adjustment is 35 times. So overall, in my view, valuations of this company are expensive. And they deserve to be expensive also because there is a consistent track record depicted by the company, and it's a cash-rich company growing by their own internal accruals. One more interesting thing to note is in the shareholding pattern from December 24 to March 25, the number of shareholders have gone down from 9,33,000 to 7,39,000. So this shows that larger shareholders are accumulating shares, more shares, and the number of shareholders are going down. This is generally considered as a positive sign. What are the risks of investing in this business? This company faces stiff competition from organized as well as unorganized players and local players in every region. From the organized segment, we have the Tata Group, the Reliance Group, and several other retail chains which compete with this business. They have high dependency in the tier 2, tier 3 towns. And if there is any incident which happens across India by in the form of change of government policies or implications of taxes or monsoons. So these kind of macro events can impact the liquidity in the hands of people in the tier 2, tier 3 cities, which can impact the business of this company. It's a low margin, high volume business. So maintaining this margin and further improving it is very important for this business. It's a lease owned store model. So even if their business doesn't do so well due to any reason, they have to pay their lease liabilities or rent. Inventory management, working capital management is very critical in this business. So right now, the company has a very good track record of managing it very efficiently, and we hope that such efficiency is seen in the longer term also. So now that you've understood the business model of the company, the growth prospects, the financials, valuations, risks. What is an overall view on the company? If you are an existing shareholder holding the stock from lower levels, you should continue to hold as the visibility of growth is still intact. And if you're looking at a fresh entry in this company, you should decide what is your style of investing. If you're a high growth investor who wants to invest in companies which are growing fast, irrespective of the valuation, then this kind of investments are suitable to you and it can give you a similar return as the growth in the profitability is seen in the longer term, because the re-rating in terms of valuations is already over. But if you are a pure value investor, then we should wait for some correction in the stock and buy at a lower level. So that's about Vishal Mega Mart. I hope you like the crisp analysis. I've tried to cover all the important points in this small video. If you like it, hit the like button and subscribe to the channel. If you want me to make videos on your favorite stocks, do mention the names of the stocks in the comment section. Even this was picked up from the last video's comment. Don't forget to join our Telegram channel using the link in the description button. Thank you for watching and have a wonderful day.